What if you want to beat the return from S&P 500? One way to do it is to invest in a growth ETF, which is an ETF that focuses on growth. That's right. They take out all of the slow growing companies and just leave the companies that are growing very aggressively. You know, all the technology companies, they leave that in. Vanguard has an excellent growth ETF, ticker symbol VUG. And on today's video, we're going to look at investing $100 into VUG every single month. We're going to look at investing $100 into VUG every single month, see where that will take us after 5, 10, 15, 20, 25, 30 years or more. Before we jump into my computer, just remember I'm not a financial advisor, just a regular guy on YouTube. I'm just sharing my passion about personal finance and financial independence on YouTube. Make sure you do your due diligence, and this presentation is for educational purposes only. Let's jump into my computer. So here we are in my computer on the Vanguard website. This is the Vanguard Growth ETF, ticker VUG, right? For people who are trying to beat the market, right? Because if you invest in S&P 500 ETF like VOO, you're going to get market returns. No better, no less. Market return. But if you're trying to beat the market, you need something else. So this is the Vanguard Growth ETF, ticker VUG. It's also available in a mutual fund, right? Available as an Admiral Shares mutual fund, but you need at least $3,000 to invest. Everything else is the same, but you'll just need a minimum of $3,000, as opposed to the VUG ETF where you can invest as little as $1. So again, the management style is index, right? It's going to try to match an index. It is the asset class is domestic stock, general, right? Large growth companies. The risk reward is a 4 on a scale from 1 to 5, which means it is more risky, which kind of makes sense because it is less diversified. These companies are going to be in only a few sectors, right? As opposed to the S&P 500, which is in all sectors, right? It's going to be more concentrated or less diversified. So the expense ratio is 0.04, which means you're going to pay about $4 for every $10,000 invested, which is great. Okay, right now it's trading about $341 per share. Okay, so let's look at the Admiral shares, because I told you it is exactly the same thing. So if you're going to buy the Admiral shares, the mutual fund Admiral shares, it's going to be ticker VIGAX, which is Vanguard Growth Index Fund Admiral shares. Everything else is the same. The expense ratio looks to be a little more, 0.05. So you're going to pay $5 for every $10,000 invested. But here you see what I told you here. The investment minimum is now $3,000, as opposed to you can buy the ETF version, VUG, starting at a price of $1, right? So let's go back to where we were. And again, everything else is the same. It's the same stocks. Okay, so VUG, the year-to-date performance of VUG since the beginning of 2024, it's been about 9.87%. Okay, so almost 10% return almost 10% return since January 1st of 2024. So the inception date for the fund is January 26th, 2004. So it's about 20 years old. Product summary. It seeks to track the performance of the CRSP US Large Cap Growth Index. It provides a convenient way to match the performance of many of the nation's largest growth stocks. It follows a passively managed full replication approach. So they try to match this index that is tracking large growth stocks. Because it is an ETF you can buy any time of the day. It trades like a regular stock. With the mutual fund, no matter what time you buy it, the transaction will only go through at about 4 o'clock. Okay? So let's look at the return. The year-to-date return for VUG has been about 10.91%. See, it matches the benchmark Exactly. The 1 year return has been about 38.84%, which is great. The benchmark, 38.90%. That difference is probably the expense ratio that you have to pay for buying VUG. The 3 year return for VUG has been about 10.93%. The 5 year return has been 17.92%. You compare that to VOO, right, which tracked the S&P 500, and the 5 year return was not that high compared to this. Now, the 5 year return for VUG has been about 17.92%. That is excellent. Look at the 10 year return. The 10 year return for VUG has been 15.07%. Right? You compare that to the S&P 500 return, or VOO, which I believe was about 11% or so. So 15%, that extra 4% in return on investment means your money's going to double a lot faster. Okay? A lot faster. That's why people invest in this growth. So since the fund's inception in 2004, the return over the last 20 years has been about 11.18%. But a 10 year return is excellent, 15.07%. Whether that will be able to be kept up, hard to say, but artificial intelligence is going great. And when we look at the companies that have the largest segment of the ETF, you can see a lot of them are involved in artificial intelligence. Okay? But we're going to keep that 10 year return in mind. 15.07%. 15%. Okay? Currently, each share of VUG is trading for about $341. The number of stocks involved in VUG is 199, as opposed to VOO, which had 500 companies in there. So it's less than half, right? So they took out all of the value stocks and it's really concentrated on the growth company. So it's less diversified, like we said before. 199 number of stocks. The median market cap for the companies involved in VUG is 1.2 trillion. These are huge companies. So half the companies are above that valuation of 1.2 trillion. The other half is below that valuation. Earnings growth rate, almost 18%. The PE ratio, 38.2. I mean, these companies are richly valued. So let's look at the sectors in VUG. The largest sector involved in VUG is the technology sector, representing over half of the ETF. 56.2% is in the technology sector, which it would explain all the rapid growth, all those companies that are involved in artificial intelligence and information technology. Those represent a very large section. I get Apple and Google and Microsoft and so on. So the next largest would be consumer discretionary, representing 19%. So those two combined represent about 75%, right? Or about 3/4 of the ETF is technology and consumer discretionary. Everything else is single digits. Industrials is the next one, next biggest, 8.9. Healthcare is 7.5. Everything else is very low single digits. Very low single digits, okay? And the names would be what we would expect. Since over half of the ETF is in technology, the names will be familiar. Microsoft, 12.8%. Apple, 11.15%. NVIDIA, 7.75% of the semiconductor company. Amazon, 6.87%. Facebook, 4.5%. Google, Alphabet Class A, Class C. Eli Lilly, which is the pharmaceuticals, but because of their weight loss drugs, they're growing rapidly. Okay? You have Tesla, you have Visa, you have MasterCard, you have Costco Wholesale. These are all, smaller, in the low 1%. Okay? So these are other names. So now that we've looked at VUG, let's go to our compound calculator and see how our money would grow investing different amounts over 5, 10, 15, 20, or 25 years or more. Okay, so here we are on our compound calculator. This one is from Nerd Wallet. So we're going to keep that 15% rate of return over the last 10 years for VUG, which is Vanguard's growth ETF, and use that extrapolating into the future and see what we would have. 15% is aggressive, but with the power of AI and the large portion of the ETF that is geared to technology, which is 56%. Let's anticipate that that will continue. So we're going to start with $100 per month. And we're going to use the 15% rate of return, right? Let's look at how much we would have after 5 years of investing. So after 5 years of investing, $100 every month into Vanguard's VUG, which is their growth ETF, right? There's only 199 stocks. We know it is more risky, but potential to get more growth. We would have $8,857 after 5 years. We contributed $6,000. And our growth, right, our dividends and our capital gains total $2,857. That's after 5 years of investing, right? $100 per month. Now let's look at 10 years. Now let's look at 10 years. After 10 years of investing $100 per month, our portfolio has grown to a value of $27,000 after 10 years, right? Investing into VUG. The total principal that we invested was $12,000. And our gain has been about $15,000, in which our gain has now exceeded the amount that we have contributed after 10 years, which is not bad, right? Let's keep going. You know, it gets better. After 15 years of investing $100 every month into VUG, right? We have now a portfolio value of $66,000. We have invested $18,000. The total gain has been $48,000, right? The gain is almost triple what we invested. Let's go to 20 years. After investing $100 per month for 20 years, our growth is now almost $150,000. We have only invested $24,000 out of our own money. The rest, the other $125,000 plus, has been from our gains. Let's go to 25 years. After 25 years of investing, right? If you look on the graph now, you'll begin to see the bending, right? That's what they call the hockey stick. Down here is horizontal, 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 and now you see the bending here. That's what you want. When it starts going up, that's when the growth becomes rapid. After 25 years, you have invested, after 25 years of investing $100 per month, you have a total portfolio value of $324,000. But you have only invested $30,000 of your own money. The total gain has been $294,000. That's your money working for you. That's compound interest working for you. Let's go to 30 years. After 30 years, your portfolio value is almost $700,000, right? $692,000, and you only contributed $36,000. The gain, the other $656,000 is just gain from your portfolio. The interest, gain in interest, reinvesting the dividends, and letting compound interest work on your side. You ever sometimes wonder why it's so hard to get your credit card balance paid down? It's because compound interest is working against you. You pay it down, and before you know it, the balance that you have gained or accrued more interest, and you got to pay that. That's compound interest working against you. This is compound interest working for you. It was Albert Einstein that said, compound interest is the eighth wonder of the world. Those who understand it earns it. Those who don't pay it. Let's go to 35 years. After 35 years of investing, After 35 years of investing $100 per month, our portfolio value is almost $1.5 million. Right? Our total contribution has been $42,000. That's it. Over 35 years, we've contributed about $42,000. That's it. But our gains have been $1.4 million. That's amazing. Let's go to 40 years. After 40 years, we have after 40 years, our portfolio value is $3.1 million. We've only contributed $48,000. The total gains, the $3 million, right? $3,053,000 worth of gains is just from our portfolio making money for us. You see, this is growing faster than VOO because of the higher rate of return, right? We use about 10% for VOO, and now we're using 15% because of the growth of AI and the growth of this portfolio that is more concentrated, right? They took out the slow growers, they took those out. So what's left is just very high growers, okay? Let's go to 45 years. After 45 years, our portfolio is $6.5 million. Right? We said that the three main factors to consider that will determine how your portfolio will grow is one, how long have you been investing? Number two, how much you're investing. And number three, the rate of return. And out of all those three, the most important one we said is the time. You like to sit and let's keep growing and compounding. But rate of return is important too. VOO was giving us 10%. We're using here 15%. So this is why after 45 years, we're already at $6.5 million. And we're only investing $100 a month. Right? After 45 years, we have $6.5 million. We have only contributed $54,000. The total interest or total gain, the total gain of $6.5 million is from our money making money for us. Now, the final slide now. Let's get a drum roll, please. The final slide at year 50. The final, at 50 years, you would have $13.8 million investing $100 per month. And listen, let me say that we cannot foresee the future. Past performance is no predictor of future performance. But we did put in 15% return, and the results are staggering. $13.8 million. Your contribution, your principal is only $60,000. That's it. $100 a month. That's less than a lot of people's cable TV. Right? That's less than insurance for your car. That's less than going out to eat at a restaurant one time. Less than going to the movies for a family of four. A $100 contribution to the right investment, leaving it alone, reinvesting the dividend can be life-changing, can be generational poverty breaking, can be generational poverty breaking. $100 a month into VUG. You have a portfolio worth $13.8 million. You've only contributed $60,000. And the total gain has been $13.7 million. That is incredible. Absolutely incredible. So the moral of the story is we have to be consistent. We have to be deliberate. So the moral of the story is we have to be consistent. We have to be deliberate. Put that money in and watch it grow. This is only $100 per month. If you like content like this, I would appreciate if you would subscribe on YouTube. We do videos twice a week, Mondays and Thursdays. Send the video to a friend, and have that friend send it to another friend or family member who needs to break the cycle of generational poverty. Until next time, continue to command your money to grow. MD Investor out.